Hello, and welcome to our March 2026 market update. My name is Doug Johnson. I am the Senior Investment Strategist here at HCM Wealth Advisors and CPAs. And today we are going to focus a little bit more on what's going on in Iran and how that is affecting markets, what we're seeing, and then trying to maybe draw some conclusions or some scenario analysis around what might happen going forward. So, obviously, there is a large human toll during any type of military conflict, and we certainly don't want to downplay that. But for the purposes of what we're trying to do today, we're going to stick to what we believe are the financial implications of the conflict that's going on right now. So, I think one of the most important aspects of all of this is going to be the accessibility of the Strait of Hormuz in terms of having oil and natural gas being able to flow through. So, just to give an idea, here's a map that shows the level of product, both oil and petroleum, from a volume standpoint that has passed through the Strait of Hormuz in 2024. So you have almost 20 million barrels of oil that comes through, and then 290 million cubic meters of liquid natural gas coming through that area. So it's roughly 30% of the global oil trade, and then about 20% of the global liquid natural gas trade. Now, from a US perspective, not a lot of the product that is coming through this channel is going to end up in the US. And you can see that excuse me, one too far. So you can see that these arrows down in the corner there, let me pull up my laser pointer real fast. You can see that a bulk of this goes to Asia, and then there's a decent amount that goes to Europe. So you have roughly 80% of the liquid natural gas passing through the strait going to Asia and 20% to Europe. So the international implications of the strait being closed, I think, are much greater as opposed to the US in terms of just product overall. Now, oil and natural gas are both commodities, and those are governed by supply and demand. So anytime you are introducing a dramatic supply shock into any commodity equation, that's ultimately going to raise the price. And we'll take a look at what it's done to the oil price in just a second. But it's also important to remember that this area does not have a giant gate, and somebody can just push a button and it closes. The threat right now is of military action from Iran, and they're essentially saying that U.S. ships are not welcome to pass through here. There's been various reports of solutions to this from the U.S. standpoint, saying we're going to have naval escorts for ships and things like that, which at the end of the day would turn out to be quite costly, and only, I would think, increase tensions further. But for now, the accessibility of this area of the world, I think, is the main thing to pay attention to as this conflict continues to evolve. Now, we mentioned oil specifically, and this chart shows the Brent crude futures curve. So the prices aren't necessarily reflective of where we are currently. Actually, they may be closer now. I think this chart was pulled as of a few days ago, and we've had a significant spike in the price of oil since then. But it's retraced most of that. So when we're looking at this is saying that Brent crude, which is a little bit different from WTI, which is the predominant oil used in the United States, but they trade in a similar fashion, was trading right around $70. I think the last I looked, it was closer to 85. But for the purposes of what we're trying to show here, that the price is not necessarily as important as the shape of this curve. So in commodities, you have the shape of the curve representing two, I guess, states. One is called contango. The other is backwardation. So backwardation is what we're seeing right now. And it's basically saying that the demand for the present day commodity is much higher than it is in the future. Most commodities will trade the opposite in a contango situation where the price gets more expensive the further out you are looking in terms of taking delivery. And if you think about it for oil, that makes sense because if you're looking to buy a barrel of oil that you're going to take delivery for, let's say in December of this year, you're going to pay the spot price, but then you're also going to be paying a storage cost to not have to take that right away. So that's usually built into the price. But in situations like this where we get significant price surges, whether that's, again, based on a supply shock, that front month or the May 2026 contract basically becomes more in demand. Now, as we look at this, the other thing that's interesting is that if you start to go out a few months, the price drops pretty substantially. So, we're looking at a front month contract here for Brent crude at $84. If you go out to the end of the year, that drops to, we'll call it 71. So it's more than a 10% decrease in the price. So it could be that the oil market is telling us that for now, this is a short-term concern, but it's not necessarily one that the market from an oil perspective sees sticking around long term. Now that's yet to be determined, but I think it's interesting to see how much the current year, or I'm sorry, the current month contract has been bid up. Now, how has that related to market performance? So this is a 6-month window here where we've got a few different asset classes on here. So you've got the S&P 500 in purple, you have the Russell 1000 value in orange, you have the Russell 1000 growth in blue, and then you have the MSCI ACWI XUS, for all intents and purposes, that is represented as international in green. So we would say up until January of this year, these all traded in a pretty tight band. And then as we had the start of the year, you can see some significant dispersion in terms of performance where you saw this rotation where things like value and international were really starting to outperform things like the market, and even areas like growth and tech that had been the dominant market leaders for the past 5 to 10 years. Interestingly, when this conflict started, you saw growth actually hold up pretty well during all this, but big sell-offs in value and specifically in international. And the international sell-off makes sense based on what we looked at earlier. I mean, if you see the amount of product that comes through the Strait of Hormuz and how much the international markets, both Europe and Asia, will be affected by that, you can see how much more leveraged those markets are to this closure. So seeing a stronger sell-off is not a surprise. The other thing is we saw a reversal in the dollar where you kind of had a risk-off situation and the dollar was bid very aggressively and saw some strength. So naturally, a strong dollar is bad for international markets and vice versa. We've recently seen a lot of dollar weakness, which had been a tailwind for international. But since the beginning of this conflict, we've seen reversals in the dominant trends from the beginning of the year. Now, the question remains, is this the end of those trends, or is this rotation away from mega cap tech and mega cap growth going to continue after this is all over? And this is a question that I don't know that has an answer right now, but certainly something that is in the top of mind for us as we kind of move through this. If we break it down on a sector basis, you've got oil here in the purple bar. You've got consumer staples in orange, and staples usually represents the most risk-off sector of the market. In blue, you have the energy sector, and then in green, you've got tech sector. So no surprise, you can see a huge spike in the price of oil and the return there. This goes back 1 month. So large vertical spike there. We've seen some retracement of that, but it's clear that the price of oil has gone up substantially. Now, there's a few things here. Both XLK, which is the tech sector, and XLP have been down as this has started, but tech has actually held up better than staples, which is a very bizarre thing to see happen in a risk off type trading environment. Again, will it continue? I don't know. But to see that, it may signify a few things as well. Staples has been a very, very strong performer year to date, and it may have just gotten a little bit too far too fast, and it's not seeing the same defensive properties that we would normally see. But in most true risk off instances, you would kind of see the opposite of this, where staples would hold up a little bit better, and tech would sell off a little bit more aggressively. The other thing that I find interesting in this is that the energy sector, while up over the last month, did not really participate in the massive spike in oil that we saw. Now, if you remember the oil curve that we just looked at 2 slides ago, with the market saying, hey, we're not necessarily sure that this is sustainable over a several month time frame, I think energy stocks may be saying the same thing and not seeing this as a quote unquote sustainable move higher in oil prices. Because if oil maintained an $80 to $85 price target for the next 4 or 5, 6 months, I would think that would be very beneficial to the energy sector, and prices would reflect that. If it traded at $120 to $150 a barrel, which I think is kind of some of the worst case scenarios that are being thrown out, I don't know how the energy sector would react to that, because at a certain point, energy prices that are too high actually work against it, because the input costs become so expensive that you get demand destruction, which then in turn brings the oil price back down. It doesn't happen overnight, but that's usually how it goes when we see significant spikes in the price of oil. Two of the most recent high profile instances we can use. So you go back to 2022, a lot of people forget, with the Ukrainian-Russia conflict, oil made it up to, I think, $120, $125 a barrel for a while. That led to some demand destruction. We had a weak year in the market, and then all of a sudden oil was trading back down, I think as low as the mid 40s, 50s for quite a while. And then if you go all the way back to the great financial crisis, a lot of people forget oil was trading at almost $150 a barrel leading into that. So that was part of the demand destruction that we saw with the recession that followed. So it's important to understand what the future for oil prices look like, because for now, what's going on, I don't think necessarily has any spillover into the US economy. I think we can split the two things and try to keep them separate. But if oil prices remain elevated for a sustained period of time, that will bleed over into the US economy and will act as kind of a headwind for economic growth going forward. And I would think overall would be a more bearish sign. Now, going into this, the market was showing a fair amount of uncertainty. So this chart here in the middle pane in orange shows something called the high-low logic index. And basically what it's saying is that there are an extremely high number of stocks in the market right now that are making both 52-week highs and 52-week lows. So there's a little bit of conflict in terms of the direction. Now, you may think about that and say, oh, that's not a big deal. But if you think about a bull, like a true bull market, this number is very low because you have a lot of stocks making 52-week highs and very few making 52-week lows. So the concern here would be that in other instances where this index has spiked up, it has preceded downturns in the market. Not every time, but you can see that in a majority of the bigger sell-offs, you've seen a spike in the high-low logic index. So it's basically the market's way of saying we need to try to find some direction here, try to find some leadership that is sticky, because if we can't, that uncertainty again can lead to more risk-off environments. Now, I wouldn't look at this and say this is the bell at the top. But as we try to take stock of all of the inputs that we look at, this is one of those things that I would say is probably not in the market's favor at the moment. It can change, but I think as we try to isolate what's going on in Iran with what's going on in the market and trying to separate those two things. This existed before the Iranian situation even happened. So the market is still trying to find its footing a little bit in terms of who's going to lead. Now, what's positive about this is the S&P on a whole is only down, I believe, close to 1% this year, maybe less than that. So the broad-based index has not felt the pain of having that lack of leadership where when when tech has struggled a little bit, you've had other areas of the market pick it up and do a lot of the heavy lifting. But in order for that to continue, if we're going to go this way, we're going to have to see a significant outperformance in areas like value and small cap and in international. And the situation in Iran may cause some issues there. Now, a lot of people have pegged this as an inflation concern, which I think is certainly reasonable. Obviously, if you have elevated levels of energy, that can lead to inflation. And you can see on this chart here, this is a 6-month chart of bond rates. You can see a spike here, both in the 2 and the 10-year moving up pretty substantially. But I think one thing to point out is that, and we'll see this a little bit more clear in the next chart, the inflation expectations from the bond side are still not at levels that we saw last year during tariffs. And if you can remember that situation, it parallels a little bit to what we're seeing right now in the sense that you almost have this binary outcome where it's almost an either or. Either this is going to continue or it's going to stop. And with tariffs, we went through a few weeks of kind of scenarios and worst case, scenarios and thinking that it was going to, make inflation go out of control and on and on and on. And then one day it was over. And we saw a big market rally. Now, granted, that took about 20% off the S&P, and we haven't seen anywhere near that right now. But we're also not seeing the inflation expectations that we saw last year. So could inflation become a concern? It absolutely could. But I think you're going to need to see this conflict lasting a little bit longer than 2 weeks before we really see inflation stick into the market. And you can see here that the market implied rate, this 5-year forward inflation expectation, has really only ticked up slightly. And then looking at it another way, these are inflation swaps. So kind of the same thing, the market's expectation of inflation. You've got the blue line as a 1-year swap, the red line as a 2-year swap, and the white line, which is called a 10-year swap, which I would almost ignore the 10-year number. I think that's too long of a time frame to be accurate. But again, we've seen big spikes. You've seen especially in the 1-year and the 2-year. But again, you're not at the levels that we were seeing in April, May, June, July of last year when we were coming off kind of the scares of what we saw in the tariff space. So again, inflation is important to watch here, but I think we're going to need to see sustained oil prices at higher levels before that becomes a massive concern. Now, history of conflicts, obviously, whenever we see war break out or military conflict, usually it's initially a risk-off event, but not always. And as we look through the history going back to 1948, the market performance in these situations is surprisingly better than you would think. These go out 5 days before the start, 5 days after, 1 month, 3 months, and then 6 months, and then also the maximum drawdown from the start. Now this is in the S&P. So if you go to the 6 month, obviously the two largest ones, you had a 15% sell off over 6 months with a 16% max drawdown during what they classify as the Yom Kippur War. Also during a kind of a similar time where you had an oil supply shock and you had oil prices staying elevated with high inflation. That there's no doubt that's going to be the worst case scenario if that plays out. But if you look at some of the other conflicts that we've seen in the Middle East, you've got the Iraq War, you've got the Gulf War, you have the Israel-Gaza war from 23, and then the Israel-Iran war from last year. And these all produce pretty positive market environments 6 months after the fact with what I would call garden variety drawdowns. I mean, a 10% drawdown is a garden variety correction that is expected to happen once every 13 months. So we wouldn't say that that's anything out of the ordinary. So as we kind of go through this, obviously we've talked about a lot of the concerns that we have, but I don't think it is all doom and gloom. A lot of times we can go to that place, but if we look at the numbers and we look at the history, it's not always a bad environment when we have conflicts like this. So outside of this, and one thing I wanted to touch on is from an economic standpoint, and we're talking a lot about inflation possibly. So the job market, or at least the job numbers from March, I'm sorry, March, but the most recent number was not very good. You had negative, I think it was 96,000 with expectations of right around 55,000 to the positive. And now we have a 3 month average that's hovering right around zero. So you can see these bars. We've kind of oscillated between good job numbers and bad job numbers. So there's a lot of confusion going on in those job market numbers. But in terms of how that how a weak job market would, reverberate in the economy, that's one of the earliest signs that we're starting to, maybe see some pressure in some of the economic numbers. And would an extended period of high oil prices maybe affect that? Yeah, I think it could, for sure. So one of the things to certainly keep an eye on is what these job numbers look like going forward, and whether or not that's going to play into the inflation story, but also kind of work as a counterweight to it, because a bad job market has historically been quote unquote deflationary, as has recessionary periods. I mean, I think the biggest concern would be kind of a period of stagflation. You've heard that word being tossed around again. Obviously, stagflation was hallmarked in the 70s, and it was a very, very rough time across the board. We're certainly not saying we're anywhere near that, but again, as we try to lay out various scenarios of what could happen, looking at various aspects and how they are affected by the markets, these are some of the things that are popping up. Now, we always want to try to provide some perspective. We've gone over a lot of things that could go wrong, but I think it's never a good strategy to bet on the worst case scenario. And this is an interesting quote from Art Cash, and it says, "Never bet on the end of the world because it only happens once, and even if it does, who are you going to settle the trade with?" Maybe that's an extreme version of it, but as we've met as an investment committee over the past few days and kind of discuss what's going on, we've tried to approach this the same way we approach anything, which is don't be over emotional, kind of let the fog lift a little bit and try to interpret the data as it is, and not necessarily try to predict the future, but react to the present. As a committee, probably a lot of people are wondering, well, are there any portfolio decisions that are being made in light of this? So far, no. That doesn't mean there won't be, but we're still trying to kind of assess the situation as it is, look at other areas of the market and figure out, okay, are there any meaningful changes that we need to make to portfolios in order to, adjust the environment that we think is playing out? We've always said that as the probabilities of things change, we will adjust the allocations accordingly. And we've acted that way really with any and all kind of, volatility environments that we've come across. Whether that be COVID, whether that be 2022, whether that be tariffs, whether that be other situations that might have felt bad at the time and turned out to be nothing. The best way to approach that is with as much objectivity as possible. So I think we're certainly working behind the scenes to make sure that we're covering all our bases here. But if we do get to a point where we're making active portfolio decisions, we'll certainly relay those to clients as they happen. And then lastly, a little bit of positive news here. So this is a chart that shows the S&P 500 going back to 1990. So a fairly large data set. And it shows periods where the VIX, which is the volatility index, has a 10-day rate of change over 50%. So that basically means that the VIX has gone up by 50% or higher over a 10-day period, while the S&P is also within 5% of its all-time highs, right? So there's been roughly, I think, 12 or 13 of those instances. And what you see here is that it's historically been a pretty good time to be adding risk. Now, we're certainly not suggesting that that's what we're doing right now. But if you look here, you have 1, 2, 3, 4, 5 day changes, which are probably too short a time frame. But if we go to the numbers and the time frames that we like to look at, 6 months and 3 months, especially 6 months, you have a 91% positivity rate during those time frames. You have a 53% positivity rate over 3 months, which isn't as good as a success ratio. One of those obviously has some bigger numbers through COVID, which is understandable. But when we're seeing big volatility spikes like this within all-time highs, it's not necessarily any indication that there's some kind of grand crash on the way, or something really, really bad has to happen. In fact, it can also lead to the opposite. So based on that, what I would reiterate is we are obviously on top of what's going on, meeting pretty frequently to figure out if and when any portfolio adjustments are needing to be made. And as I mentioned, nothing has been done right now, but that doesn't mean that can't change over the next week or two if we feel that the need to do something is appropriate. Even with that said, as always, if you have more questions, comments, concerns, please don't hesitate to reach out to your advisor. We're happy to jump on a phone call or have a meeting to discuss things that may be specific to your portfolio. Or if it's a situation that you're just not comfortable with what's going on, we can always make adjustments to appease any client request that comes along. So we would welcome the opportunity to talk to you if you have questions. We will continue to try to communicate as news changes or pops up, either through the webinars or the podcast series that we've also launched. But if in the meantime you want to talk before then, please feel free to reach out to your advisor, and we're happy to help. So until next time, take care, and we'll talk soon.